Good morning, everyone, and welcome to the Morning Bell. I'm Robert, and it's Tuesday, February 17th, 2026. Joining me as always are Lizzie and Steve. We're coming off a long holiday weekend, and markets are trying to find their footing amid some significant developments. Lizzie, there's quite a bit happening across different corners of the market. What's capturing your attention this morning?
Thanks, Robert. Well, the big story dominating conversations is this continued pressure we're seeing across risk assets, particularly in tech and crypto. We're watching the dollar strengthen as currency traders are increasingly betting on fewer Fed rate cuts this year, which is creating headwinds for growth-oriented sectors. What's particularly notable is how this is playing out in the semiconductor space, where we saw Nasdaq futures leading losses with chip stocks weighing heavily on sentiment. There's also some interesting corporate governance news, with Goldman Sachs planning to scrap DEI criteria for its board. And we're seeing activist Elliott Management building a substantial stake in Norwegian Cruise Line, which has that stock moving higher in pre-market trading. The broader theme here is selectivity, Robert. Markets are no longer giving everything a free pass. We're seeing real differentiation between companies that can execute and those that can't. On the regulatory front, there's growing concern from global regulators about banks' rising use of credit risk transfers, with the Bank for International Settlements highlighting that the lack of data on these synthetic risk transfers is actually hindering proper risk assessment. This echoes some of the pre-2008 concerns about opacity in the financial system. What's particularly interesting is how investors are positioning themselves. We're seeing stock pickers argue that this current environment, especially with the AI volatility we've experienced, is actually their moment to shine. The indiscriminate buying we saw last year is giving way to much more thoughtful analysis of fundamentals, margins, and execution capability.
That shift towards selectivity is definitely a theme we've been tracking. The idea that active management might finally have its moment after years of passive dominance is worth watching. Steve, let's turn to the economic picture. What are the data points telling us right now?
Thanks, Robert. We're in an interesting period where we're actually dealing with delayed economic data releases, which is creating some uncertainty for traders trying to position ahead of key readings. Treasury yields are moving lower this morning as investors look ahead to more of this delayed data finally hitting the tape. The big picture here is that we're seeing some divergence in global economic conditions. In the UK, we just got an unemployment jump that's fueling bets on imminent rate cuts from the Bank of England, with analysts now pricing in a higher probability of easing in the near term. That's a stark contrast to what we're seeing in the United States, where the data has been resilient enough to keep the Fed in a holding pattern. The dollar strength we're seeing reflects this divergence, as traders are recalibrating their expectations for Fed policy. Instead of the multiple rate cuts that were priced in at the start of the year, we're now seeing a more conservative outlook, with fewer cuts expected through 2026. This Wednesday, we're getting the FOMC minutes from the last meeting, which should provide more color on the committee's thinking around the inflation trajectory and labor market conditions. The housing market data continues to show stress, with commentary suggesting that conditions are not getting much better, despite the hope that lower rates would provide relief. What we're really watching for is whether the economic data can support the current market valuations, particularly in sectors that have run up significantly on growth expectations. The challenge for investors is navigating this environment where the macro backdrop is shifting but hasn't yet shown clear directional conviction. We need more data points to confirm whether we're heading toward a soft landing scenario or if there are more significant headwinds building.
That uncertainty around the Fed's path is clearly weighing on rate-sensitive sectors. Lizzie, let's talk about today's stock of the day. You're looking at Sandisk Corporation, which has had an absolutely remarkable run. Walk us through what's happening there.
Robert, Sandisk is one of the most compelling stories in the semiconductor space right now, and it perfectly illustrates both the opportunity and risk in this market. The stock is trading at $626.56. And here's what's remarkable. It's up 1,229% over the past year and 128% year to date. This is a company that has successfully transformed itself from a consumer flash memory manufacturer into a critical supplier for AI data centers. The thesis here is straightforward. Everyone focuses on NVIDIA and GPU demand for AI workloads, but these systems require massive amounts of NAND flash storage, and that's where Sandisk comes in. The company reported third quarter revenue of over $3 billion, up 61% year over year, with earnings increasing more than 5 times. What's particularly interesting from a valuation perspective is that despite this massive run, the forward price to earnings ratio is only 7.75, which seems incredibly cheap for a company growing this fast. 19 analysts cover the stock with a consensus buy rating and a target price of $724, suggesting about 15.5% upside from current levels. Now, here's where it gets nuanced. The price-to-book ratio of 9.08 is elevated, and the stock has no trailing PE because of recent profitability challenges. though the forward metrics show strong expected earnings. This is a high beta name with extreme volatility. The stock hit a 52-week high of $725, but also traded as low as $27.89 just a year ago. The opportunity is clear if AI infrastructure spending continues accelerating and the NAND flash supply shortage persists. This stock could potentially reach $800 to $900 by year-end. Some analysts are even suggesting it could double. However, the risks are substantial. Any slowdown in hyperscaler spending from Microsoft, Amazon, Google, or Meta would hit this stock hard. The Fed policy we were just discussing matters enormously here because higher rates pressure high multiple tech stocks. There's also execution risk. The company has to deliver on these aggressive growth expectations, with essentially no room for error. Competition from Micron, SK Hynix, and Samsung is intense. For traders looking at this, I'd say it's a buy for risk-tolerant growth investors, but you need to size positions appropriately. Consider scaling in during volatility rather than chasing at current levels. And think about setting stop losses around $550 to protect against macro-driven sell-offs. This is not a stock you buy and forget. It requires active management given the volatility profile.
That's a thorough breakdown, and it really highlights how even stocks with strong fundamentals require careful risk management in this environment. Let's shift to crypto. Lizzie, what are you seeing in digital assets?
The crypto market is under significant pressure right now, Robert, and it's reflecting many of the same macro concerns we're discussing with equities. Bitcoin is trading near $68,000 after dipping below $70,000. And we're seeing the fourth consecutive week of outflows from crypto funds, totaling $173 million. The sentiment has turned cautious, and there are some specific catalysts driving this. First, we learnt that the Harvard Endowment reduced its Bitcoin ETF stake by 20%, while actually adding a new Ethereum position, which tells you something about how sophisticated institutional investors are thinking about relative value in crypto. There are also some bearish warnings getting attention, including Mike McGlone suggesting Bitcoin could fall to $10,000 if US recession risks build, though I'd note that's a tail risk scenario rather than a base case. What's particularly concerning is commentary from BlackRock's digital assets head about leverage-driven volatility threatening Bitcoin's narrative as a stable store of value. We're also seeing some technical concerns, with Bitcoin's weekly RSI echoing patterns from the mid-2022 bear market. On the risk side, there's emerging discussion about quantum computing potentially eroding Bitcoin's edge over gold, though that's a longer-term theoretical concern. Now, it's not all negative. Ethereum is actually showing relative strength, outperforming the broader crypto market after a $540 million sell-off. There's technical analysis suggesting ETH could rally to $2,500 if certain conditions are met, and we're seeing interesting developments like Polygon's daily fees actually flipping Ethereum amid a prediction market boom. For Solana, the picture is more neutral, with price action likely to track the broader market. The actionable insight here is that traders should be cautious on Bitcoin in the short term, with that $68,000 support level being critical to watch. If we break below that convincingly, we could see further downside toward the low 60s. Ethereum looks relatively more attractive from a risk-reward perspective, especially if you believe the technical setup for a move to 2,500 holds. For anyone holding crypto positions, this is an environment where risk management is paramount. Consider reducing leverage, tightening stops, and being prepared for continued volatility as macro conditions evolve.
Well, that certainly paints a picture of a market in transition, whether we're talking about equities, economic data, or digital assets. The common thread here is uncertainty and the need for disciplined risk management. As we've discussed today, there are opportunities in names like Sandisk for those willing to accept the volatility, but the macro backdrop with Fed policy, dollar strength, and shifting investor sentiment means this isn't an environment for complacency. Steve's point about waiting for more economic data to confirm the direction is well taken, and Lizzie's emphasis on selectivity in both stocks and crypto makes sense when markets are no longer giving everything a bid. For those of you listening, the key takeaway is to stay nimble, size positions appropriately, and don't chase momentum without understanding the underlying risks. This Wednesday's FOMC minutes should provide some additional clarity on the Fed's thinking, and we'll be watching how markets digest that information. As always, remember to do your own research and consult with financial advisors before making investment decisions. That's all for today's Morning Bell. I'm Robert, thanks for listening, and we'll see you next time.